All right, we've got some breaking news here from a Palm Beach Business AM studio. If you're invested in the stock market, beware. Former hedge fund manager Teeka Tiwari has just issued a new warning to Americans. Teeka, who in 1991 famously became the youngest VP in the history of Shearson Lehman, has just released a new report about a colossal crash that's expected to begin unfolding from here to early 2015.
The time to get out is now. If you've got any money in bonds, mortgage REITs, munis, utility stocks, preferred stocks, so-called safe money, get out now. It's gonna be a bloodbath.
Teeka, who's been called Mr. Crash after making a fortune from the Asian financial crisis of 1998, has a history of making jarring yet accurate forecasts. For example, during a Fox Business News interview on December 21st, 2007, Teeka called Citigroup shares bloated, and the banking giant would end up falling 95%. And on September 15, 2008, with the Dow trading north of 11,300, Teeka did it again. Here's what he said.
Could it get a lot worse?
Well, the traders that were on before said it best. I mean, we break through 11,000 on the Dow. That's breaking through key support. That means we're going to 10K, 10.5. You know, the ugliness continues.
The Dow would end up bottoming out below 7,000. But Teeka has now issued what may be his most controversial call of all time. He's calling for a collapse in the income market that could be worse than 2008. In fact, it's already started to happen. Earlier this year, Teeka alerted subscribers of his Mega Trends investing letter about a list of stocks he believes will be affected by this coming income collapse, like Impact Mortgage Holdings, which has fallen almost 30% over the course of the year, and Genie Energy, which shot straight down not long after Teeka issued his first warning. But now Teeka has identified a new trigger point in January that will set the event he's calling income extermination into overdrive. He estimates many retirees who've been chasing yield in dividend-paying stocks, munis, and other safe harbor income plays could be wiped out entirely. That's why he's released an updated video brief outlining what's going on in the markets right now and why it's about to crash. He's also agreed to offer our Business AM viewers free access to this list of crash stocks to avoid, as well as 3 investments he believes will help us not only survive, but thrive in the months ahead. We've obtained permission from Teeka to air his special briefing. We'll just head to that commercial now, and we'll be back with this urgent warning in a minute. All right, I just wanted to remind you that we've cleared today's scheduled programming to bring you the full, unedited screening of Teeka Tiwari's urgent stock market update. If you have money in the stock market, and especially if you're retired or almost retired, and have any money at all in bonds, REITs, or other income investments, please pay special attention. A reminder as well that Teeka will be offering our viewers free access to his new report on the complete list of stocks that could completely wipe you out in the next 6 months, as well as his 3 investments that could make you rich. Cutting to Teeka's update now.
Dear friend, on March 17th, the U.S. government is going to make a move that could radically alter your retirement. Certain stocks could drop by 80%. Bonds and funds could drop even further. Certain bank accounts may become almost worthless. In other words, many investments that are popular today and have been attracting millions of investors since the last market crash of 2008 will no longer be relevant. How is this possible? Well, this coming March, a branch of the U.S. Treasury Department will make a move that will affect America's income markets in a way this country has never experienced before. Like a violent tornado, this event will cut a path across sectors, industries, and markets, stunning investors and businesses alike. Those who aren't prepared for it could lose everything. It is not yet a widely known fact, but in the highest financial circles, word is starting to spread. Risk is building behind the scenes, said Rebecca Patterson, who heads up the Bessemer Trust, which manages $75 billion. 2 of America's largest banks, Bank of America and Goldman Sachs, have already issued warnings to high net worth clients and the press. but mainstream media seldom reports on disasters until after they occur. In fact, by the time most people realize what's at stake, it will already be too late. Investors may never recover, writes Gail Beebe, a personal finance author and market journalist for Canada's Globe and Mail. Already, big hedge funds are preparing for this day. The world's largest asset manager has already moved $1.5 billion in anticipation. Another large group has pulled $21 billion out of traditional income investments this year alone. Now, why would the government do something that would cripple the markets? It has no choice, writes the Wall Street Examiner. You see, recent developments in the U.S. Treasury Department have placed them in a position where they must act fast. The government has indicated it will choose what it considers the lesser of two evils. As economics commentator Michael Snyder writes, we are truly moving into unprecedented territory. Since this news came to light, we've identified 385 investments we believe are in immediate danger. There's a good chance you own at least one of these through a brokerage account, mutual fund, 401k, or other retirement account. In a moment, I'll share 36 of the most at risk with you. That way you can get out of them now before it's too late, and give you the time needed to take advantage of the small handful of opportunities that will flourish from this move long before anyone else figures it out. And I don't just mean safe places to merely park your rescued cash while the dust settles. I'm talking about specific investment opportunities that could double within a month or two of this event happening as scared money rushes in. I'll give you certain names that could soar 1,000% or more as billions of dollars abruptly shift out of once safe investments. I know that sounds unbelievable, but I'll show you the facts a bit later. I'll also show you how professional managers have already begun moving millions into these types of plays. People like Bill Gates, John Paulson, Jim Chanos, and the legendary manager Jeremy Grantham. But first, it's crucial you protect yourself. And to do that, you need to understand why this event, which one analyst has dubbed income extermination, is about to happen, and how it will redefine the rules of income investing. I know what I'm saying is a little bit out there. After all, folks have been crowding into dividend-paying stocks, bonds, and funds ever since the Fed began driving interest rates down to zero. You don't have to believe me now. Just review the facts, and you make the decision whether this makes sense or not. My name, by the way, is Teeka Tiwari. You might recognize me from TV as a regular contributor on CNBC and the Fox Business Network. The appreciation I have for risk today came at a huge personal price. In 1998, I made a large fortune during the Asian financial crisis. But then I got greedy and held on when I should have exited my positions. The Fed cut interest rates, my positions moved against me, and I lost everything. I mean everything. That night on the way home at Grand Central Station, I seriously thought about throwing myself under a train. I couldn't believe it. I was financially ruined. Years later, I made back that fortune, and I emerged with a healthy respect for risk and a real understanding of how badly things can go wrong when we get comfortable or arrogant with our investments, even with the money we'd always considered safe. Since then, I've spent most of my time sharing my experience with my readers, good people who don't want any more BS. The work I'm most proud of is doing my part to keep these folks safe from crisis. In February 2007, I warned investors to steer clear of the subprime crisis. Here I am below on ABC News in 2008, just 3 weeks after the market crash, talking to Nightline's Bill Weir. I was fortunate to not only stay safe during the crash, but many of my readers used my recommendations to make a lot more money during the turmoil. But the event I'm tracking today has me more concerned than anything I've seen before. Because if what I'm seeing is true, regular investors, even retirees who have their savings in super safe funds and fixed income investments, will likely be hit hardest of all. Utility companies, highly leveraged businesses, certain blue chips, pension funds, they'll all suffer losses too. In the following video, I'm going to tell you everything I know about this income extermination, what it is exactly, what's going to trigger it, what caused it, and I'll show you my red flag list. This is a list of 385 investments that will be hit the hardest. I can email it to you as well. Stay tuned to the end. Finally, I'll show you what I think is the absolute most important thing for you to do to keep yourself safe during this crisis and make a lot of money in the process. Before I show you what's going to happen, it's important that we agree upon our situation today. You see, much like prisoners of war, many of us have begun to accept our current situation as normal, sort of like a coping mechanism. But what's been happening lately is the furthest thing from normal. For many years, collecting income was simple. We'd buy bonds, dividend stocks, funds, collect healthy yields, and everybody would sleep okay at night. But the crisis of '08 changed everything. It demolished 401ks and other accounts and prompted the Fed to start slashing interest rates. I mean, think about it. It doesn't matter if you are getting a 2% dividend, a 5% dividend, or even a 10% dividend. When the entire market drops 40%, anyone holding these investments gets crushed. And that's exactly what we saw in 2008. And since then, everything we knew about retirement planning changed. Yields disappeared. CDs began paying next to nothing. Annuity streams dried up. Safe stocks that used to pay a good yield either cut their rates or stopped altogether. What happened next? Many of us kept buying this stuff anyway. Others in desperation began chasing some dangerous yields, and they probably don't realize it. Just take a company called Great Northern Iron Ore Properties, GNI. At first glance, Great Northern has an amazing yield, 41%. Investors have been piling into the stock the past few years. But here's the thing. The iron properties funding Great Northern's super high yield will soon run out. And because of the way the company is structured, they can't acquire any more resources. In fact, GNI has stated that it will officially dissolve within the next year. Do you think investors who bought shares recently bothered to check that fact? My point is, the income market has become irrational and dangerous, but it's happening slowly, so most investors have just been accepting it as the new normal. Many of us have been lulled into complacency by finding stable yields during a period of turmoil and low rates. But many of these investments, even blue chips and utilities, stocks that have always been the safest, are riddled with problems. They're overextended, overbought, and overleveraged. They're borrowing money in the credit market to pay dividends and attract more investors. Yet many of them don't even have the cash to pay interest on these loans. Let me show you exactly what I believe is going to happen within the next 6 months. In the next 6 months, almost every significant income-related investment in America is going to crash. How do I know this is going to happen? Because the same circumstances that led to the tech stock crash and the real estate bubble are now happening in the income markets. Only this time, it's much, much bigger. Check this out. The U.S. stock market is roughly $15 trillion. The real estate market at the height of the bubble was $27 trillion. But the U.S. income market has become the biggest market on the planet. Munis, corporate bonds, U.S. Treasuries, money market funds, REITs, utilities, debt-sensitive stocks, bond funds, and a few other classes make it up. At more than $38 trillion in size, it's grown bigger than the stock market, it's bigger than the housing market. Here's a snapshot of how absurd this market has become. The U.S. Treasury market has grown 560% over the past 5 years. People are willing to lend money to the government for less than the long-term rate of inflation. Utility stocks, which usually trade at a discount to the market, are now trading at a 50% premium. And bond funds, which typically hold a mixture of bonds, have quietly been buying stocks instead. How did this happen? How did this market get so big and bloated? More to the point, what's going to cause it to pop, and why will the Fed be powerless to stop it? Let me explain. All it will take to pop this bubble is a simple pinprick, a simple trigger event. When it happens, the ripple effect will cause tens of trillions in bonds, stocks, and other income-related investments to plunge in value. Some stocks may even go to zero. I know this may sound hard to believe, but as I'll soon show you, there are forces that have been building behind the scenes for decades now. All it will take to unleash them is a simple event. I believe that will happen when the Fed announces at its open market committee meeting on March 17, 2015, that it will raise interest rates. You see, toward the end of January, the U.S. Commerce Department will release GDP data for the fourth quarter of 2014. Part of this data is something called the PCE index. Simply put, that's a measure of the inflation you and I see as we go about our daily lives, paying the electric bill, topping off the gas tank, and the rest. Of course, the Fed is worried all the time about inflation. They're printing all of this money, and so they keep a careful eye on how much money is in circulation and how much prices are rising. Recently, inflation has crept up to the highest level we've seen in a year and a half. And Dallas Fed Chief Richard Fisher has even said that the Fed may have to raise rates sooner than most people anticipate. I believe inflation will hit the Fed's ceiling of 2.5% when that number is released in January. And according to their own guidelines, the Fed is in a position where they absolutely must raise interest rates. I'll explain what this means in just a few moments. Incredibly, that's all it will take to trigger income extermination. The cause, as I'll show you, is much deeper. It has to do with systemic issues affecting America's money and credit markets. It also explains why, no matter what else happens in the next 6 months, we'll still see a complete extermination of safe income plays. First, let me show you how this crisis will likely unfold. This March, when the Fed raises short-term interest rates, they'll not only rise, but they'll rise much faster than anyone expects. Government bond yields will rise too, including the 10-year note. Most people don't realize this, but the 10-year note has a major influence on the U.S. economy. When it goes up, all sorts of other rates and loans go up too. I'm talking about consumer loans, mortgages, corporate bonds, credit card rates, airplane leases, boat loans, car loans, truck loans, you name it. They'll all rise when the 10-year rises. Rising rates means lower bond prices. So if you're locked into a bond, you'll see its value plummet. Bond funds will be hit even harder. Any and all investments that are sensitive to interest rates, including many stocks, will get crushed as well. This crisis will strike in 3 waves. The most leveraged, riskiest stuff will get crushed first. I'm talking about things like mortgage REITs, mortgage-backed ETFs, and junk bonds. They're riskier, so they have higher yields, but they'll also be the hardest hit when rates start rising. In fact, for reasons I'll explain shortly, this process has already begun. Just take a look at a popular mortgage REIT on our red flag list. As you can see, in the past 6 months, this stock has dropped more than 25%. Many investors, even newsletter writers I know, have this stock in their portfolios. As income extermination gets into full swing, this stock and others like it will drop even further. I found 38 other mortgage REITs just like it. I'll give you the names a bit later. Check any mutual funds you have or other accounts. Make sure you don't have any exposure to them. The same thing applies to many preferred stocks. Many of these investments have no maturity dates, so when interest rates spike, there's no way to get your money back. No company will redeem them. Your money will be trapped. As these riskier, more interest rate sensitive investments begin crashing, a holding pattern will develop. People will begin wondering if this is just a downturn or if it'll get worse. But then the second wave will hit, and they'll know the answer. The second wave will begin as income extermination wipes out the front lines and starts hitting some of the more quality stuff. I'm talking about many MLPs, investment-grade corporate bonds, municipal bonds, and over 80 utility stocks. You may be wondering, if these are higher quality income investments, then why will they get hit? Because they use debt to finance themselves, and they're interest rate sensitive. Consider the municipal bond market, or munis as most folks call them. If you don't own any of these bonds outright, your mutual fund or 401k probably has exposure. For decades, many smart investors have been investing their safe money in munis. But when income extermination hits, these bonds will get crushed. Alan Sloan, a senior editor at Fortune, has called munis a train wreck waiting to happen. I believe we're already seeing signs of it. The yield on munis, which is typically 25% lower than other bonds, is now higher in many cases than corporate bonds. The fact that tax-free is higher than taxable is absurd and signifies an inefficient market, said David Kotok, Chairman and Chief Investment Officer of Cumberland Advisors. But munis are just one small part of what income extermination will affect. The third and final phase will begin infecting the U.S. housing market as new borrowers get frozen out and folks looking to sell their homes will be stuck. Long-term government bonds, the income sanctuary of last resort, will get hammered too. But wait, why should you care if interest rates go up? Doesn't that mean you'll get better rates on your bonds? That's not the case. As interest rates continue to climb, bonds of all types will continue to see their value plunge. Why? Let's say you buy a $100 bond that pays you 4%. If interest rates rise, there are new $100 bonds now paying 6%. Who in their right mind would want to buy your older bond that yields less? Nobody would, so the price drops. Then if rates climb to 6.5%, no one would want to buy the bond paying 6%. So the price of the 6% bond will drop as well. Do you see how this works? It's a dangerous cycle. Here's another reason you won't get a better yield on your bonds. Interest rates don't act like stocks. They don't have a quick reaction and then settle down. When interest rates change direction, they do so for decades. In 1946, interest rates were 2.2%. But over the next 26 years, they moved up mildly, just to the historical average of 6.4%. How bad could that be? Well, had you held bonds over that 25-year period, you would have seen your so-called safe bond money decline by 30%. And from 1966 to 1981, when bond returns averaged negative 4.2% a year, you'd have lost 67% of your portfolio. Every $100,000 you put in would have only been worth $32,800 by 1981. The same applies to long-term bond funds too. As bond prices keep falling, the fund managers will be constantly selling and buying new bonds with new rates. As a result, their values will plummet. In just a few moments, I'll show you my red flag list of the 385 names that will get hammered. And I'll also show you 3 opportunities that will flourish as this disaster strikes. These investments will throw off tons of income and will rise in value too. But first, you should know that what I've told you so far about income extermination isn't even the half of it. As I hinted at earlier, rising rates are just a trigger. The real forces behind this event have been taking shape for decades now. Let me explain. For the past 100 years, the Federal Reserve has used interest rates to both slow down and speed up the economy. Here's what I mean. In the late 1970s, inflation was really high, between 9 and 11%. The Fed wanted to slow down the economy, so they jacked up interest rates. When rates are high, people don't borrow money. If they do, they have to pay sky-high interest rates, so they keep their money in the bank instead. As a result, the economy cools down, money goes out of circulation, and inflation cools off. Cutting rates has the opposite effect. The rental price of money becomes cheaper. More people are willing to pay interest to borrow it, so the economy heats up. That's what happened after the stock market crash of 1987. The Fed cut rates to stimulate the economy and markets. But here's the thing. This power is almost too great for one small group of bankers to possess. Despite their Harvard degrees, these are, after all, 7 mere mortals playing God with an economy of 300 million people, and their meddling causes problems. Big problems. What does any of this have to do with income extermination? Plenty. You see, our government, through the Federal Reserve and U.S. Treasury, has interfered one too many times with the free markets. Every time they raise or cut interest rates, buy bonds on the open market, or change banking requirements, they are tempting forces beyond their control. They've done this off and on since the Fed was founded in 1913. But really, since the 90s, this manipulation has accelerated. It's reached a point where the markets, which are as natural a force as the Mississippi River, must flow freely. We don't see these forces building because the Fed so far has managed to avert a Depression-style crisis. But they always end up causing an even bigger one in the process. Let me show you exactly what I mean. In 1998, Long-Term Capital, a high-profile hedge fund, lost billions overnight. The Federal Reserve was anxious about the banking system falling apart, so they intervened. The New York branch organized a bailout with some of the biggest banks on Wall Street, and the Fed central bank lowered interest rates. They wanted to encourage frightened investors to borrow money at low rates. In 3 months, interest rates dropped 0.75%. While the banking system stabilized, something else happened too. You see, any time the Fed tinkers with the financial system, there are side effects. By pumping money into the system, the Fed helped to create one of the biggest bubbles in the history of finance. At the time, the dot-com sector had already been heating up. If left alone, it probably would have fizzled out in the fall of '98. But because the Federal Reserve injected easy money into the system, they created a massive bubble. The market realized the Fed wasn't going to let long-term capital or any other financial groups fail, so the dot-com party raged on. Plus, because the Fed lowered interest rates, tech companies could borrow even more money cheaply. It was like pouring gasoline on a speculative fire. But by 2000, the dot-com bubble was deflating at full speed. Millions of investors were getting crushed, and the Fed began tinkering once again. As the internet bubble was popping, the Fed cut rates on 12 separate occasions, a total of 4.25% in a single year. This fueled an even bigger bubble in an even bigger market. Of course, I'm talking about housing. The real estate market in America is $27.18 trillion, even bigger than the stock market. The Fed made the cost of money so cheap that everyone started buying homes. As you can see in this chart, housing prices started taking off around the time the Fed began lowering interest rates. As Ron Paul said in 2002, like all artificially created bubbles, the boom in housing prices cannot last forever. And of course, the bubble popped in 2007. But Wall Street was mixed up in the mess. So the stock market and banking system suffered too. It was the worst crisis since the Depression. And we have the Federal Reserve to thank for it. Even worse is how they dealt with it. Their actions have no precedent. They interfered in a brand new way, and by doing so, they've created one of the biggest bubbles to date in America's biggest market. This brings us back to today and the market reckoning heading our way. The Fed's meddling has finally reached a breaking point. After the events of 2008, in an effort to control the global economy, they pressed one too many levers. First, they took interest rates to zero. That's even lower than the previous two bubbles I described. In fact, that's never happened before in American history. Then they changed bank collateral rules. Simply put, the Fed really lowered its standards on which banks it would lend money to. Even banks with junk on the books qualified for loans. To make matters worse, after maxing out those two options, they began affecting long-term interest rates by buying U.S. Treasuries on the open market. This is a tool the Fed has never used in any serious way. In short, the Fed has been buying up trillions of dollars worth of 10 and 30-year U.S. bonds. It's what they call quantitative easing. By doing so, they've been pumping money into the government's coffers and lowering long-term interest rates in the process. Which brings us back to today. This zero interest rate policy, ZIRP, has essentially screwed millions of Americans. In the short term, you get nothing in your checking account. And in the long run, you can't find safe yields that outpace inflation. And it's created the biggest bubble in American history. When the Fed raises rates, that's all it will take to quickly pop and deflate this massive income bubble. Let me show you what I'm talking about. And to do that, I need to answer an important question, which you might be wondering yourself. Why would the Fed willingly trigger a crisis? Let me explain. Why would the Fed raise rates if it means bad things will happen? Well, because they've placed themselves in a very bad position. If they continue pumping money into the system, they risk price inflation. So there's really one choice here. They have to raise rates. The Fed even told Goldman Sachs and JP Morgan recently they need better capital levels before the end of the year. In other words, they're tipping the banks off to what's about to happen. They're telling them to batten down the hatches. But here's the thing. Today, interest rates are already beginning to rise on their own. Since last year, rates on the 30-year bond have risen by 15%. Mortgage rates have jumped 17%. Rates on the 10-year have climbed even higher, as much as 48%. Plus, I already showed you how interest rate sensitive stocks have been falling recently. The same is true with muni bond funds. Just take a look at a popular muni bond fund on our red flag list. It's down 11% since last summer. And look at this long-term government bond fund, also on our red flag list. It's dropped as much as 10%. When the Fed officially raises interest rates this March, the whole income market is going to come crashing down. But as I mentioned, I have a 3-step plan for surviving and even prospering during this crisis. Here's what I recommend you do right away. First things first, check your income holdings. Look at your 401k and other retirement accounts. If you have any mutual funds, see what you're invested in. Look at your brokerage account. Do you own any ETFs? I've found 43 that are set to be annihilated. What about REITs and utility stocks? Do you own any long-term bonds or bond funds? These will get hit the hardest. Most people don't know this, even folks who own bonds. But when rates rise, bond prices go down. It's a law of financial nature. I've studied every corner of the income markets: bond funds, bond ETFs, income stocks, mortgage REITs, leveraged MLPs, cash flow negative dividend stocks, utility ETFs, telecom stocks, preferred stocks, junk bonds, and I've come up with a red flag list. There are 385 investments you simply must get rid of. I know that went fast. It's a long list, and we don't have a ton of time. If you'd like a hard copy, I tell you what to do in just a moment. That brings us to step 2. I found 3 safe opportunities for you to sock away your money as this income crisis hits. You should consider moving your money into at least one, if not all, of these safe havens right away. There may not be a better secret in any financial market than what I call unlisted yields. Consider one such company, a manufacturer and steel producer. It trades on the New York Stock Exchange. As you can see, Yahoo Finance lists their yield as 4%. That's pretty good. But many folks are collecting as much as 12 and 13% from the same stock. Keep in mind, this is low-risk income, unlike the junk many people have been piling into. How is this possible? Unlisted yields are often safe companies listed on the stock market, but due to a quirk of stock math, the full potential of their yields is not listed on any public market data site like Yahoo, Google, or Bloomberg. For that reason, many folks looking for income never see these companies. As one East Coast financial publisher familiar with this opportunity put it, their true yields are kind of disguised. I found 2 of these companies. I never would have known to look for them if I hadn't learned about the unusual potential of their yields. Over the next few years, as traditional income plays get crushed, these unlisted yields stand to pay out a lot of safe income. What's great about their dividends is that they're not going into debt to pay them. So when interest rates spike, they'll be immune. I recommend you add these names to your income extermination portfolio right away. I've written a 40-page briefing detailing this event titled How to Survive and Prosper in the Coming Income Crisis. This is the most comprehensive piece of research I have ever written, and to my knowledge, the only one of its kind in existence today. Toward the end of this video, I'll give you passwords to download a free copy if you'd like to learn more. Inside this report, you'll learn everything you need to know about this event. You'll have full access to my red flag list. You'll learn the absolute best ways to add income to your portfolio from the unlisted yields I've found. Plus, you'll learn about 2 other ways to boost your income as this crisis hits. Remember when I told you bonds and bond funds are going to lose a lot of value as interest rates climb? Well, I found an exception to the rule. It's kind of like a bond, but trades more like a stock. Thanks to a special provision, instead of losing value as interest rates rise, this investment resets, so you continually get paid on the new interest rate, no matter how high rates go. This is a sophisticated way to generate high income as income extermination strikes, but it's super easy to invest in. I guarantee no one else is looking at this idea, and I found 2 ways to take advantage of it. You'll find the full details inside my report, which you'll get free of charge. Before I show you how to access your copy, let me tell you about the third and final step you should take right away. When interest rates are soaring, smart money will begin piling into a few key asset classes, and you should too while it's still early. In short, this coming crisis is presenting you with a once-in-a-generation opportunity to make a significant amount of money from the financial markets. During the last period that was even remotely similar to this event, investors like George Soros, Bill Ruane of the Sequoia Fund, Warren Buffett, Jim Rogers, and many others laid the cornerstone of their future financial empires. That brings us to step 3. Set aside a small percentage of money for calculated speculations. Already, some of the smarter professional money managers have been doing just that, like Stephen Cohen, the popular hedge fund manager who recently increased his holdings of an internet technology and encryption company by 150,411%. And Joel Greenblatt, head of Gotham Capital, just increased his position in a tiny video and fiber optic company by 1,854%. This is a guy who normally buys big companies like Foot Locker and Wells Fargo. In short, there's a real opportunity to make a fortune in small companies with good balance sheets and strong prospects for growth. But this situation won't last long. We haven't had a real income crisis in several decades. As the income crisis hits, smart and dumb money alike will eventually pile into these stocks, sending their prices soaring. You still have time, but the best time to get in is right now. Let me show you one step 3 opportunity you should consider taking advantage of as this crisis hits. By now, I'm sure you've heard of America's shale energy boom and the incredible fortunes being created in places like Texas, North Dakota, Louisiana, and Pennsylvania. Thanks to advances in technology, companies have been accessing geological formations once considered unreachable. As a result, shale companies have made a killing since 2009. EOG Resources has risen 238%. Pioneer has climbed 1,381%. And Magnum Hunter Resources is up an incredible 2,652%. Now, America has even more recoverable energy than Saudi Arabia. So much, in fact, it's even exporting energy. But here's the thing. These fields, the Bakken, the Eagle Ford, the Marcellus, Haynesville, Barnett, and there are a handful of others, will continue to produce energy for America for decades to come. But the opportunity to make money here, substantial money, has come and gone. The good news is I've learned about an energy formation that's bigger than all of those fields combined. It's in a place you'd never suspect and where you can still have the potential to make a lot of money even if you've missed out on the shale boom so far. According to the U.S. Energy Administration, it holds more shale gas than all of the fields discovered in America and Canada to date. It could be the world's biggest shale gas reserves, writes a reporter from Reuters. This is no ordinary shale. For starters, the gas it holds is nearly twice as valuable as regular shale. Second, it's trapped in a different type of sediment, a dark mineral. Some people call it black rock. Already, corporate America is pouring billions of dollars into mapping these enormous fields. Government wants in on the action too. They want to see 20,000 shale gas wells drilled here by 2020. And they're putting up good money to make sure it happens. They've pledged to invest as much as $98 billion over the next 7 years. If this shale field is bigger than everything else discovered to this point, then why haven't you heard of it? Well, one reason is the shale gas isn't actively flowing yet. You see, it wasn't until shale gas wells were producing that the big TV outlets started reporting on the Bakken and the Eagle Ford. If you remember, the same thing happened with Canada's oil sands back in 2006. But there's another reason you haven't heard about this opportunity. It's located in a highly unlikely place, a location not known for mammoth energy finds. Now is the perfect time to take advantage of this BlackRock energy opportunity. And I found 2 companies with potential to make you 6 to 8 times your money over the next 24 months. If you're interested in learning more, I'll send you my special report called The Shale Story No One is Telling. Inside, you'll learn everything you need to know about this opportunity. I'll send this report to you free of charge, along with the other research I've mentioned. So far, I've covered 3 steps you need to take right away to plan for this crisis. Step 1. Check my red flag list. Make sure you don't own any of the names on it. Step 2. Get exposure to the income investments that will flourish as interest rates rise. And step 3, set aside some money for smart speculations, because there will be big opportunities to make 4, 5, even 10 times your money or more. If you're interested, I will send you all the research you need to take advantage of these opportunities, and I'll send it to you free of charge. Here's what I mean. I will include all of this research, all of the special briefings I've mentioned at no extra expense when you start a no-risk trial subscription to my new monthly publication called Teeka Tiwari's Megatrends Advisory. What separates my newsletter from the hundreds of other research advisories out there? Well, I know from experience that your success as an investor will come down to 3 or 4 critical decisions about big events in the markets. That's it. Making the right choice can dramatically change the trajectory of your life. Let me show you briefly what I mean. When the high interest rates of the 90s began dropping, I had a big decision to make. Stay on the sideline or suck it up and make a move I knew would pay off. I was a young man at the time and naturally was quite nervous, but I knew this opportunity was too good to pass up. So I bought $7 million worth of 30-year Treasury strips for my clients. Interest rates were at about 9%. As rates dropped, we profited. I ended up making a small fortune in the process. When the junk bond market crashed in 1992, I had another personal turning point to face. The common view was junk bonds are dead, but I thought everyone was flat out wrong. So I could either act in the face of popular opinion and make another fortune, or do nothing and hope I wasn't right. Of course, I chose the road less traveled. I looked for companies with recession-proof cash flow like RJR Nabisco, which had 17.5% bonds, and companies like Eastern Airlines, which had liquidation values much greater than their debt. Both of these bonds made high double-digit gains. In mid-December 2010, I reached another fork in the road, and this time it had to do with cotton. My data was telling me it was about to make its biggest move in 150 years, and if I stayed on the sidelines, I'd probably miss out. So I pulled the trigger and ended up making 730% on my positions. My point is, in your lifetime, you will be faced with a handful of decisions that will change your life forever. This might be whether to invest $20,000 in a cool and ambitious startup in 1980 or getting out of stocks in March of 2000. These forks in the road can change your life forever. Some of these moments may have already passed you by as you watched your friends get rich from a stock or business opportunity, while you stayed in the same tax bracket grinding it out. In megatrends, my goal is to make sure you never miss out on another one of these opportunities. I believe you and I are facing one of these right now with income extermination. Actually, it's two of these big moments wrapped into one: a chance you'll lose a lot of money if you do nothing, and an opportunity to make a fortune as you get out of these shaky income plays. For me, these critical decisions have come my way out of necessity. I think you can probably tell this by now, but I don't fit the Wall Street mold. I don't have a degree from Harvard. I don't have wealthy parents. Everything I have today, I had to work hard for. At 16, I took a risk and came to the States with $150 in my pocket. By day, I bust tables for $3.75 an hour at Donald Sachs in the financial district. By night, I loaded freights on Brooklyn's docks. It's funny what you can accomplish when you have nothing to lose. Every day, this Wall Street titan would come into the restaurant, and every day I would hound him for a chance to work at his firm. Finally, a year later, he gave in. He probably just wanted to enjoy his meal in peace. I quickly worked my way up the ranks. I learned how to evaluate companies, bonds, trades. By 20, I became the youngest vice president in the history of Shearson Lehman. By the time I was 23, I had made and lost $1 million. At 27, I was a millionaire several times over. Along the way, I observed firsthand how some folks are born rich. They have everything handed to them. But for the rest of us create and keep our fortunes through calculated decisions. Oftentimes, these are unpopular and difficult to make. The opportunity we have with income extermination may be the biggest I've seen in my career. It's a huge trend that will change the way people think about collecting income and investing for years to come. I've been studying trading and investing based on interest rates for over 2 decades, and I've never seen an event of its magnitude. And it's bearing down on us in less than 6 months. That's why you need to get my research in your hands right away. When you take a trial subscription to my new advisory, you'll receive 12 issues of Megatrends. Every month over the next year, you'll receive my monthly reports on the best opportunities in the markets. I'll continue to track the coming income crisis, update you on our positions, and tell you about any new opportunities I come across to protect or grow your wealth. How to survive and prosper in the coming income crisis. Inside this special report, you'll find everything you need to know to prepare for income extermination. You'll see the full list of 385 toxic names you must get rid of. Plus, you'll also learn the 3 unique ways I found to collect income. These plays will flourish while traditional income investments get obliterated. The shale story no one is telling. If you missed out on the incredible energy boom taking place in the US, then don't worry. The industry is mobilizing around a new discovery that's bigger than all of the shale fields found in America to date combined. I found 2 ways to make serious gains from this discovery. When I told my clients and subscribers that I was launching this service, many of them were kind enough to send notes of encouragement. Harry Rowe, a 52-year-old former car engineer and part-time property manager in Oregon, thanked me for being a great instructor. He told me he made money on every play I recommended. 66-year-old Don Oxley sent this flattering note. My background is in construction in Southern California. With Teeka's help, I now have a second career investing in the market. I have tried many financial products and newsletters over the years, and Teeka's is superior to the others on several levels. Using his position sizing technique has helped me sustain and grow my account consistently. Without limitation, I recommend you get on board with Teeka. Your account will thank you. Mark Costas in North Texas thanked me for helping him generate annualized returns of 430%. And Chad Ingot, a 62-year-old retired engineer who lives on his sailboat in the San Francisco Bay Area, tells me he made $20,000 in 2 weeks thanks to my advice. So how much does my new service cost? And how can you get started? I think it's absurdly cheap, especially when you consider all of the time and money my team and I have put into this research. Just the research we've conducted on income extermination has taken 6 months. Before I give you the details on how to get started, however, I'd like to tell you about one more exciting opportunity that most people have never considered. Everyone knows about Warren Buffett, arguably the most successful and definitely the richest investor of all time. But what very few people know is that Buffett's firm, Berkshire Hathaway, has made billions from a secret investment I guarantee you've never heard of. It's not a bond or an option, nor is it a stock of any kind, but you can buy it just as easily, and the returns are often much higher. Consider one NYSE-listed financial company whose name I'm sure you'd recognize. Over a 2-year period, its share price rose about 125%. That's a fantastic return, especially over such a short time frame. But you could have made a similar play using the secret investment instead and made 280%. That's the same company, the exact same time frame, and more than twice as much in profits. How is this possible? Well, in the 1920s, big companies like AT&T and Ford began offering this investment to attract big money investors. These are deal sweeteners designed to coax big names into buying shares of a company. In the past, only big-name investors typically knew of these no-brainer opportunities. But today, it's entirely possible to buy these investments on the open market. If the underlying stock doubles, you're in a position to triple or even quadruple your money with this play. If the underlying stock triples, you stand to make 600 to 900%. I've included all the information you need to know about this rare and incredible opportunity in a report called Warren Buffett's Secret 600% Investment. Inside, you'll learn 2 great ways to capitalize on this idea. Even though the upside here is very high, 600 to 900%, the risk is quite low. I'll show you how this is possible inside the special report. You'll get this research free of charge when you take a trial subscription to Megatrends, my monthly research advisory. Here's how to get started right away. 1 year of Megatrends will cost $99 a year. I think that's a great deal, especially when you consider the minimum account I used to manage at my hedge fund was $100,000. But today, I'd like to offer you an even better deal. You can get a year's worth of my research for less than a week's grocery bill. Take advantage of this special charter offer and try my research for 50% off the regular price. You'll pay just $49 for an entire year of my work, including Research Report Number 1, How to Survive and Prosper in the Coming Income Crisis. Research Report Number 2, The Shale Story No One is Telling. Research Report Number 3, Warren Buffett's Secret 600% Investment. 12 monthly issues of Teeka Tiwari's Megatrends, my monthly research advisory, sent to your inbox the second Thursday of every month. Plus, once a month between issues, you'll receive my monthly minutes. This is a webinar I put together which I'll email to you. Inside, you'll learn about any changes to our recommended plays, any new developments in the markets that can't wait until the next issue, and I'll answer general questions or comments I've received from you and other subscribers. Why such a low price? Well, this is a brand new newsletter. I figured the best advertising for my research is for you to see my work yourself. To make that as easy as possible, I've made it available to you at a charter subscriber rate. But this introductory offer won't last long, so take advantage of it today while it's available. You'll have a full year to evaluate my work. If at any point during the 1-year subscription you decide it's not right for you, then contact my customer care department and you'll receive a full refund. That way, trying my research is a completely risk-free proposition. Remember, income extermination will hit us with full force within the next 6 months, but signs of this crisis are already starting to appear. So hit the subscribe now button at the bottom of the page. Thanks for watching. Good investing. Oh, one more thing. When you take a trial subscription to Megatrends, there's one more piece of research I'd like to give you at no additional charge. It involves a bizarre loophole I call extra dividends. These companies will prosper during the coming crisis, but more importantly, they're paying out dozens, sometimes hundreds to thousands of extra cash distributions on top of their regularly scheduled dividends. Click the subscribe now button and check out the order form for more details.